There's a common misconception that investing is only for the elite. Let's go ahead and shatter those myths together because in this video, we will debunk the myths surrounding investing, empowering you with the knowledge to start your journey towards financial growth, no matter what your current financial status is. Hi, I'm Dr. Joanna Ray with Sustainasol, and I'm here with you for another episode of Financial Fridays. And today we'll be talking about when is it a good time to get started with investing and what are some of the things that you need to consider before you start investing. First of all, I do have a video which talks about how to get started on setting your financial goals. And I'm going to go ahead and link that video up above. But first, let's see if we can understand the basics of investing. Basically, investing, which is different from savings, is actually where you get your money to work for you. And it actually does with the concept of compound interest. Build on your money and makes it so that you don't have to work as hard. And the beautiful thing about investing, whether it be in equities such as stocks and ETFs, or whether it be in things like real estate, is that you tend to get a return on your money that is higher than what you would get in a savings account. That's not to say that investing is without risk, and we will get into the concept of risk tolerance in a bit. But basically, because you are getting a return on your money, whether you are investing in equities or investing in real estate, there is a certain amount of risk that the amount of money that you put in is not actually fully kept. So in some instances, and I'll give a quick example from my life, I did buy a house in the early 2000s, and luckily I sold that house just before the housing crisis. Now, if I would have kept that house during the housing crisis, the house that I bought would have had actually reduced in value below the purchase price, making it a bad investment for the time frame of what I'm looking at. However, over time, now that house has appreciated to a value that is higher than what was my purchase value. And it is just a matter of timing, and there's so many factors, but we will get into some of the basic considerations to think about before you start investing. Now, with this all said, a prerequisite to investing is to really have $1,000 to $1,200 in the bank for your emergency fund. And really, it's best if you have 3 to 6 months worth of expenses in your emergency fund. This is my high recommendation because you do not want to be pulling out of your investments, especially if your investments go below the cost basis or the amount of money that you put in, the value of the money that you put in. Definitely think about having that strong financial foundation before getting started and actually having a very minimal amount of debt, perhaps only a mortgage or student loan. Then think about your financial goals. Again, looking at what are you investing for? Are you investing for your children's education? Are you investing for your retirement? So there could be short-term, medium-term, and long-term goals. We get into that a little bit more in the previous video that I mentioned on setting financial goals. And then also, why don't you go ahead and mark in the comment section below, what are your financial goals? With that, of course, there are the concept of time horizons and looking at what is the length of time that you plan to hold this investment. Is it a few weeks, which could be something like a treasury bond or a certificate of deposit or a CD? Or is it something like a period of years? That might be something like real estate or equities. And then going to the concept of risk tolerance, which I mentioned earlier, there really is an importance in understanding your risk tolerance, which might also change over time. So different people have different risk tolerances, which means what is the amount of risk that you're willing to accept in that potential loss to your investment? Remember, we do hope that the investments grow and you get a return on your investment. However, that's not always the case. And again, I'll give you another example from my life. I started investing just before the housing bubble or the financial crisis crash in 2008. Basically, I saw my portfolio value drop significantly, probably something like 40 to 50% in a very short period of time. And if I would have taken that money out at that time, I would have realized a significant loss to my portfolio. However, because my time horizon was very long and my risk tolerance at that time was fairly good because I was fairly young, I did not pull my money out, and now I have significant gains on that initial investment. So think about your risk tolerance, and definitely as you approach retirement age, this is going to change, and you're going to probably want to make your portfolio a little bit more conservative But if you're young, you might want to put a little bit more on the growth side, a little bit on the high risk side, and we can keep that risk tolerance for a while. But then you're going to want to make your investments a little bit more conservative so that you're not feeling the fluctuations of the market and you're not having that significant risk to your portfolio value. And I do recommend that don't look at your portfolio, especially if it's something like stocks and ETFs, because you can see it on the fly. Don't look at it so often. I know I struggle with this. And it's just if you have an issue with seeing your portfolio down, you're going to get sad when the portfolio is down and you're going to get excited when the portfolio is up. And that's really not what we want to do because we want to just dollar cost average. And I do mention this in multiple videos, dollar cost average. Just keep on putting your money in. Basically, market conditions can change. I've mentioned a couple examples, both in the housing market and the stock or equities market. There's no such thing as perfect timing. There have been so many studies, but basically, if you want to buy at the lowest value and sell at the highest value, you're gonna not always be able to guess and time exactly when those events are happening. Nobody has a crystal ball. I don't. We just don't know the future. We just don't know. So the best thing to do, like I mentioned before, is just dollar cost average. Sometimes you're buying low, sometimes you're buying high, but you're consistently buying at whatever amount that you said, at whatever time intervals that you said, and you're doing that rain or shine, no matter what the market is doing. Start small. I know that when I started investing, I got a chunk of change. This was from the sale of my house, and I put a large amount in, and I didn't have a lot of money to put in afterwards because I moved to Thailand and whatnot. But after that, when I got back to investing, I started putting in a certain amount every month, a little bit at a time. And I started a little bit small because I was afraid of what was going to happen when I put my money in and I didn't know where this was going to go. I mean, I believed in the concept of investing, but I hadn't experienced it for myself really, other than that initial lump sum. I just started small and continually dollar cost average. I do recommend this as your primary strategy, especially into something like an ETF. This is an equity traded fund which has multiple equities in it, like a basket of stocks, and keep on investing and then start to see the result. Don't buy and sell, just hold, buy and hold, and see what happens to your money over a period of a couple of years. And if you start to feel more comfortable, then maybe double down when you've got a bonus or a salary raise. Go ahead and put those salary raises or that bonus into the market if you don't have it allocated for something else. Diversification is so important. You don't want to be 100% equities. You don't want to be 100% real estate. You don't want to be 100% cash. So cash has its own downsides, which we won't get into here. You want to diversify your portfolio of investments and not have everything in one thing because one thing could be doing well and another thing could be doing poorly. So we want to balance that out. And the concept of stocks and bonds and real estate and even something a little bit riskier like crypto as a speculative play could come into play in your portfolio. And also looking at resources for education. I'm going to link some of my favorite ones down in the description box below. I like so many channels here on YouTube, which you do have to take with a grain of salt and do your due diligence. But it's really so important to think about, how can you increase your financial education, your financial literacy, and to be informed about how the market is doing to an extent that you feel comfortable investing and also varying your strategy as needed. So in the beginning, just dollar cost average or DCA, DCA, DCA. But as you get a little bit more comfortable and you got your feet wet, maybe do get a little bit more knowledge about what you can do to increase your rate of return. And maybe you'll feel a little bit more comfortable doing slightly riskier investments or slightly larger investments. So we do want to progress as investors. I just want to mention again that a prerequisite to investing is to really have a little bit of financial education to the point where, read something like The Simple Path to Wealth. And I'm going to go ahead and link a book review, which I've done on that book. It's a great book by J.L. Collins. It's a fundamental book to looking at how you can invest in a very easy way. And the concept is he wrote some letters or emails to his daughter. His daughter was not interested in investing like he did. He wanted to make a concept of how you can invest very easily and still become very rich. So remember to have your financial goals set as well as your prerequisite to investing, which is at least $1,000 to $1,200 to even get investing on a very small level and preferably an emergency fund of 3 to 6 months. And that can get you started at investing at $50 or $100 a week and hopefully pushing that to more. I'm investing about 50% of my income every month, and that's me trying to catch up. And I do have a lot of videos on my portfolio because I am tracking my journey to financial freedom and I'm trying to reach a goal of $1 million+ in the investment portfolio for my retirement. Thank you so much for watching. I'd like to invite you to click like and subscribe if you like this content. It helps me so much with the algorithms, and it also gets me a chance to see what it is you like to see. And I want you to check out this next video, which is on compound interest, an important phenomenon in investing. And I'm going to go ahead and link that here.